Hey, welcome back, fellow investors. I want you to forget about Nvidia and the AI hype for a moment because I've discovered two industrial stocks that I feel are going to outperform a lot of AI stocks out there. I know Wall Street always sleeps on other industries because Wall Street is always focused on the thing that has the most hype. And currently it's AI and companies like Nvidia. But there's so many other companies out there which you can put in your portfolio to diversify it so that you can get a great return by the end of the year. So in the next 5 minutes, I'm going to show you 3 stocks, and I will show you why these companies are even way better than a lot of technology stocks out there. And you want to have these stocks in your portfolio so that it can be diversified and that it can grow at a very fast rate. I'm also going to show you a strategy that you can use to get the maximum output from these stocks, because unlike tech stocks, they don't move as fast. So there's a different strategy that you can use to get the biggest return from them. In this video, I'm using the same strategy that I used recently on Tesla, and the viewers of this channel saw a 30% return in just 4 days. But that's not all. If you sign up for my newsletter in the description below, I will share with you my most profitable stock strategy. Beginners and professionals can use this strategy. It is a strategy that helped me make a 70% profit in HIM stock in only 2 weeks. Don't let that chance slip away. Sign up to the newsletter, get that free lesson, and go through it. Subscribe to the channel and turn on your notifications because I release these videos a day before the stock market opens so that you can profit in time. Now, the first stock that I really love is called Fix. It's under the sector called engineering and construction, as you can see. And the reason why this stock is amazing is because, first of all, it has great earnings. If you want to know a company that has great earnings, I like to use this really simplified table. You can come into the trading view and then look for this table. It's an earnings table, and then you can put in revenue, earnings per share, and net margin. So if you see a company that's doing great, you want to see earnings per share of 30% over the last 4 quarters. So this is year over year. Then there is revenue, and then there is net margin. So you want to see earnings per share growth, which is 30% over 4 consecutive quarters. You want to see revenue, which is at least 15% average over the last 4 quarters, which this stock has. And then you want to see a net margin that is positive. That means the company is making profit. So starting out this year, we can see that this stock has already done very well. So if you bought this thing at the beginning of the year, we can see that the return was about, let me see, it has currently returned 83%, way better than the stock market, which has currently done 20%. So this stock is outperforming the market by a lot. And another reason why this stock is really good is that it's going to all-time highs. The reason why you want to buy a stock at all-time highs is that normally when a stock is at all-time highs, there is no resistance from above. So there are no people who are looking to sell it and short it immediately. People are looking to cover up for their losses because the stock is just entering new price territory. So it can just keep going higher and higher. And then the sky is the limit. Now, of course, I'm not saying this thing is going to go up 1,000%, but it could go up maybe anywhere from 20% to 80%. We cannot know. But right now, this is a good investment stock. And the way to enter such stocks is to you can enter just a little bit. Let me use an example from the past. What you could do is the first time I'd enter is here while it's pressing the 50 line. That's the first entry that I would do. I maybe put in a third. When it comes to the 20 EMA, I'd put in a little bit more. And then once it's being supported by the 50 moving average, then I would put in a little bit of more stock. So let me say that your average price is 189 and you've put about 15% of your portfolio in this, then you would have gotten an 80% return. Of course, you're not likely to sell at the top, but maybe out of that 80%, you got something like maybe 60%, which is really great, I would say. So that was the first stock. The second stock that I really like is called EME. This is also in engineering and construction because as I showed you that stocks normally move in sectors, right? If you want to have the best return, you want to be in the best sectors. So I'll show you what I mean. So engineering and construction sector. Let's see, where is the sector? Engineering and construction, right here. Yeah, so engineering and construction sector is doing great. We can see engineering and construction sector. The top stocks in the sector, let me see. if we look at the top stocks in the sector, you'll see that they're all going up because all stocks follow an industry. So you want to be in the best industries. So there is IESC. Now this one has done 144 for this year. You don't have to be exactly in the highest rising stock. You just want to be in the safest and the best stocks in the sector. And as you can see here, I like to use ticks to show that the investment growth is good and that it has super great fundamentals. So here we can see a tick on investment and good fundamentals. So I like EME and FIX in this industry. Now there's some other riskier stocks in the industry like DY. There is IESC, but I'm not going to present those to you. I'm just focusing on this particular two because the sector is looking like it's starting to go up. So EME, we can see that from January, this one did 88%. So this is my second pick if you already didn't see that again. So FIX was the first one and EME is the second. Why is EME a very good stock? Return on equity, you want return on equity, which is above 17%. This return on equity is 28%, which is way above what we need for a super growth stock. I told you earnings per share, if it can average 30% over the last 4 quarters, this one is doing 69, 79, 77. This is great. And another thing why this stock is really good is that the earnings per share is not only increasing, it's accelerating. So it started out from 48%, it goes to 65, then 69, then 79. So it's like an exponential curve up. Revenue is great. We can see an average of at least 15% over the last 4 quarters, or you can get 20% over the last 2 quarters. And it looks like it's starting to break out. This is a stock in which I already took a position here, and I'm waiting to add when it corrects to the 20-day moving average or the 50-day moving average. So that's a good way to profit from these stocks. And you can wait for it to close under the 50-day moving average as an investment play, or you can trade it, which is a different strategy. But this is one of those investment grade stocks. The third stock that is great and is setting up is something which I actually held earlier this year and I sold it. As you can see, it's called BLBD. Why is this a great stock? I'll show you. So what we can see that it's coming back above its 50-day moving average. The 50-day moving average is still sloping down. So here you'd advise just, if you want to put in $1,000 in this thing, just put in like 300, right? Because the safest time is for it to cross over the 50-day moving average and then it comes correct and then you can add. So that's what happened here. I didn't buy it at $19. I bought it around 26, but I sold it around 55. That was my profit. So I got it around here, 26, and I sold it around for 110% return. I remember very well. But for those who are better investors, they could have gotten it here around 19 when it crossed this huge consolidation. You can draw a line. You can see it did cross up. And then this was the first time to add here once it comes in correct. And then you could have added here. And then you could even have sold here at 38 if you're not sure. But the reason why I didn't sell or why it was not a good time to sell this stock yet is that it closed under the 50-day, which is normally a sell signal, but it only stayed under the 50-day moving average for less than 4 weeks. You added back. So if you had a position, let me say from $25 like I did, I would have held it through earnings because I had a 40% cushion. And then once it gapped up on earnings, you can add more shares because once it gaps up like this into new price territory, like I already told you, it's going to all-time highs, then you keep adding. And of course, when you see their earnings, they're amazing. Return on equity, 115%. We only need 17%. Earnings per share, year-over-year growth is crazy. It's growing at the same rate as Nvidia. Of course, it's not the same as Nvidia because the revenue is not the same. Nvidia is getting billions of dollars while this one is only getting hundreds of millions. But in terms of growth, this company is still growing. So I would say that this is a great pick. The time to get aggressive on this stock is if it crosses above $60 because now it has crossed above the previous high. So right now, you want to just be a little bit careful. Just keep adding a little bit, but don't throw your whole life savings into the stock. Once it crosses above 60, then I would say it's time to get aggressive. So there are different ways to keep playing these stocks. You could have it in your portfolio for a longer time, but you can also trade around it. For example, this earnings play was one really successful trade that I did. And if you want to learn more about my trades, please sign up for my newsletter that I have. And also, when you sign up for that newsletter, you're going to be getting free tips and updates on how to do this place. Thank you.